Welcome, everyone, to a special episode today where I have two guests, our lead analyst, Logan Mohtashami, and also Josh Romney. Josh is the president and CEO of the Romney Group, which owns and operates multifamily, office, and industrial properties throughout the U.S. And he's also the chairman and CEO of Intercap Lending, which is licensed in 43 states and is headquartered in Utah. I recently moderated a discussion between Logan and Josh at the Intercap Lending event, and it was so much fun we wanted to bring Josh on here to give our wider audience a chance to hear them together. So Logan, Josh, welcome.
Thank you. It's great to be here.
It's wonderful to be here. The hair game has some competition today.
Listen, I am always outclassed on the hair game, but today, it's just doubled. So I agree with that. So Josh, let me start with you. You come from a family with a long history of government service, and specifically housing. So of course, your dad was governor of Massachusetts. He was the senator from Utah. He was a presidential candidate, and your grandfather, George Romney, was HUD secretary under Nixon. So it's kind of like having housing royalty right here. It's so fun to have you on.
I appreciate it. Yeah, we go way back. And my grandfather and Nixon didn't always see eye to eye. And it's they had their battles over the years. It's kind of fun.
No, it's really fun. One of the reasons I wanted to have you on is because you have such a broad perspective, right? So you're a developer, you're an investor, you're a lender, you're kind of seeing it single family, multifamily. So would love to kind of start out this conversation by saying, we've had a lot of things happen over the last couple of weeks since the new administration has come in. What from a business standpoint has been helpful there and what has been challenging?
I think a lot of us came in with this new administration hoping that there'd be some clarity about what the plans were. I think, as we've seen things progress over the last month or so, I think the real challenge is the uncertainty of what's going to happen over the next 4 years. And so we kind of, Trump will say one thing, and we're not sure if that's actually what he means and what's going to happen. And so it's created a lot of uncertainty for a lot of our potential clients and for us as to what the next 4 years is really going to bring. We are obviously very interested in having rates lowered. That helps in every business I'm in is having lower rates. And so we're kind of watching closely to see what's going to happen, what the administration can do, what signals they'll provide both in terms of tariffs and other things that would potentially impact rates. And so we're kind of watching that closely. And as of, as a real estate developer, we really are interested in obviously onshoring and seeing those things happen. And I think there's some people that are excited that tariffs might create that. But, tariffs over the short run really don't do anything in terms of onshoring. And I think a lot of what we're seeing, a lot of the rhetoric is really just a negotiation tactic and not necessarily aimed at bringing businesses back to the United States.
Well, Logan, I know that echoes some things that you've been saying on this podcast, how you feel like this really isn't, he's not really looking for long-term tariffs. Do you want to jump in on that?
Well, same game plan in 2016 to 2020 that we incorporated, that we've talked about here. If somebody really wanted to put tariffs as a principal policy, they would literally just sit there, put the tariff on, and let many, many years go by and adjust things to how the new normal will be. And just this morning, there was supposed to be an announcement on reciprocal tariffs given, and President Trump moved that away to May or April. This is just how he operates. And there's a lot of confusion. I think how I try to get people to think is, in 2018 and 19, even with the corporate tax cuts in place, business investment went to zero. And that was not part of the game plan. But if companies don't know what the rules are, then you're going to pull the strings back just to make sure that you're not spending where you shouldn't be spending. And the confusion that Josh is talking about is going to be prevalent until we get clarity. If you're going to do tariffs, just do it and then let the chips fall where they may. I just think it's very difficult for us to be an exporting economy with the dollar so strong, but we do have advantages over countries like Canada and Mexico that so much of their economy is exporting stuff to us. So if you want to use the tariff as a negotiation tactic, That's one thing. But I think still the confusion is a lot of people just don't know what the rules are or what's going to be. And this is just the environment we're going to have to be in. And since November 7th, we did that podcast, Sarah, everything kind of looks right to me with a lot of back and forth and not a lot of clarity. But we'll see how this goes. Every day is going to be interesting. And this is how it's going to be for the next 4 years.
Josh, when you look at you mentioned mortgage rates or interest rates, maybe not just mortgage rates. How do you plan for that across all these businesses when, I feel like over the last year, we all thought rates were going to come down when they didn't. We all thought, things might change differently. It feels like 2025 is a lot more like 2024 than maybe we were all hoping. What's your view on that?
Yeah, I think we always planned rates would be longer or higher longer than we expected. I don't think anyone expected they'd stay high all the way through 2025. But at this point, we are planning 2025 to look a lot like 2024. We're not really seeing rates come down. I think with the markets priced in one quarter point decrease from the Fed in 2025, which is really not going to move the needle very much on rates. And I think until we really start to see the economy falter or sputter in some way, we're just going to have consistently high rates. The economy with the brakes on the way they are. I mean, Jay Powell has put, he's done higher and faster rates than he's ever done in history, than the Fed's ever done in history. And the fact that he's done that and the economy is still booming. We still have persistent inflation. We still have low unemployment, stock market all-time high, gold at all-time high, all these things happening. The economy should be, in a traditional sense, the economy should start to be falling apart. We should be looking at recession, all that stuff. And I don't think anybody's predicting that. The economy is just really strong. And so we're anticipating a longer period of high rates. And we're planning the business around it. We are built to, our company at least is built to succeed with higher rates for a long time. But we're gearing up for it.
Logan, jump in there.
Well, there's a lot of discussion lately about how do we get rates lower, right? And one of the things that are being talked about, I know a lot of people in the mortgage and real estate people are sending me, well, what if we just fire all the federal workers and cut the budget down and bond yields and interest rates will go down? That is the marketing game plan for something like this. I would caution people, 65 to 75% of where mortgage rates or rates go in general is Fed policy. And that's how it's been, since the Peloponnesian War. Here, what we're talking about is what the president or the head of the White House counsel, if we create more labor supply and lower aggregate demand, bond yields and rates should go lower. That's the game plan. It's the same thing that Jerome Powell kind of talked about lowering aggregate demand and creating higher labor supply. Well, the unemployment rate is 4%. Job openings have come down. Quits percentage have come down. Wage growth that the Federal Reserve tracks on the Atlanta Fed is back to pre-COVID levels. The one glimmer of hope that I would say for 2025 that is different than the past 2 years is that because the Fed started the rate cut cycle, if they can get 1% more rate cuts into the system, even if the economy wasn't breaking, you can get rates lower to the point to where the housing market, builders, everyone performs a little bit better. We've all seen this 6% mortgage rates. Everything does get better. We've been staying at around 7% and the data doesn't get that good. But really it is either you get economic weakness or the Fed cuts rates 1% and the labor market still stays intact. That would be the best case for 2025. But I think there was a lot of confusion when Kevin Hassett talked about, well, we need aggregate demand to go lower and create more labor supply. So there's all this discussion about how much money the government's going to save. Well, if the bond market really thought that is going to be like a big deal, 10-year yield would already be lower than what it is currently today. Of course, it's inflation week. We've had a whiplash while the CPI inflation was hotter, 10-year yield went up. The PPI inflation data was cooler in the sense of what filters itself to the PCE inflation. 10-year yield went down, but we're basically here. We're still elevated before any of the CPI reports. And a lot of that has to do still with Fed policy, quantitative tightening, the economic data, GDP still running at 3%. We still have a lot of deficit spending in the economy. So it'll be interesting to see for the rest of this year that does the bond market actually take bond yields lower if they believe that if you're taking money out of the economy through less government spending, is that enough to push bond yields down? Time will tell on that, and we'll see how the Fed reacts to anything on the negative side if the White House Council does get what they want, higher labor supply and lower aggregate demand.
And my concern on that is, we're bringing in, the federal government brings in about $5 trillion a year and spends $7 trillion right now. And, $5 trillion of that $7 trillion is non-discretionary. They have to spend it. And so they're kind of dealing with a $2 trillion budget that they're trying to cut, essentially to make to get back to break even, we have to cut 100% of federal spending, which is just not going to happen. And I'm not convinced that the changes they're going to make are really going to have a significant enough impact to really affect the 10-year. But we'll see how that plays out.
So much of the government budget is mandatory payouts, Medicare, Medicaid, Social Security, net interest payments. Everything else is kind of on the margin, even if you include defense spending into that. We are an older country. I always like to show these elderly dependency ratios. We have a lot of people ages 65 and on, so the mandatory payouts are going to be higher for the rest of the century out here. So it will be interesting to see the final budget, because I'm just assuming that whatever budget is created is actually going to have lower Fed funds rate, so they're going to have lower interest payments to pay out. We'll get that document soon enough, but this is the first time that we're actually seeing an attempt to reduce government spending in any kind of way that might be able to stick with congressional power. So it'll be interesting for me to see how the bond market reacts to something like that. But again, to Josh's point, majority of our budget is mandatory payouts that has to be given out. Revenue, just to give everyone, I know a lot of people think that we can just do tariffs and that'll replace income taxes. I think just off of paper napkin math, you have to have tariffs at 73% on everything to match the income tax revenue, just to do a one-to-one base. So that's obviously probably not going to be the case here. So we'll see what the tax policy is, especially if President Trump wants to keep his tax cuts permanent. But this will be the first time we'll see this. But always remember, wait till you see the final paperwork and see if it gets executed, and then take a look at what the market reaction to that is.
Yeah, and I think the one thing that potentially would move the needle is if the administration signaled that they were willing to tackle entitlement at some level, even on the periphery, just to say, well, we'll raise the retirement age over the next 20 years by a year or whatever that is. I mean, if they even hit it on the periphery, I think that might start to move the needle a little bit. But that's where the real money is being spent, is in entitlement.
Yeah, I think Social Security and Medicare are kind of going to be off the table. Medicaid, that could be worked, but again, it's all speculation at this point, and we're just going to have to see what the final paperwork is. But I know that at least for the last 5 to 10 days, I've just been bombarded by, well, DOGE is going to make sure that government spending is less, and that will help with the bond market and the Fed funds rate, but time will tell on that, because again, Fed policy is majority of where mortgage rates and interest rates and the 10-year yield is. So we had big deficits, and back during COVID, we were spending a lot of money, but rates were a lot lower. So now with quantitative tightening and the Fed still believing they are restrictive, right? Whether you and I believe the Fed is restrictive or not, that does not matter. They still see it as restrictive. If they can get 1% more rate cuts into the system, the whole curve becomes a little bit lower. It makes 6% mortgage rates a little bit more plausible, staying down there a little bit longer than what we've seen in the past few years.
So, in all of this talk about economics, what we know for sure is that at least in the last administration, housing was not part of the equation. I mean, they were looking, what could they do in the overall economy, and whatever happened to housing happened to housing. We have seen a change in this administration, really, focusing more on housing. President Trump has talked specifically about rates. For both of you, though, like as they're making some of these cuts, housing is so weird because like if the economy's going great, we're so glad for that, right? Yes, all these engines running, but that keeps rates high. To get rates lower, I mean, something has to kind of happen bad in the economy, correct? For housing. So how do you square that? Josh?
Yeah, it's an unfortunate reality of real estate is we kind of root against employment, and we're kind of rooting for some weakness. But I do think there's a balance, and Logan's made the point that 6% really gets us there. And at our company, at least, when rates hit 6%, we saw refinance activity really pick up. We saw new originations really picking up. So I don't think it has to break, and I don't think anybody in the business really wants rates at 4% right now, or even lower. I don't know if they'll ever go lower than that, but that would be we'd be back in that cycle of escalating home prices beyond what most Americans can afford. But housing, it will, especially as you look state to state, there are certain states that are becoming completely unaffordable that aren't building any affordable housing. And I think that's going to really start to be an economic drag for certain states that cannot provide adequate affordable housing for a younger workforce or for people starting in their careers. And so I think every administration is going to have to take a real serious look at it and what has to be done on the federal level to create more affordable housing, and it's going to be a real economic drag, I think, if we don't figure that out.
When we think about housing and economic cycles, when you keep rates higher for longer, it eventually goes against what you're trying to do, right? The best way to deal with inflation is supply. And of course, it was the most aggressive rate hike cycle ever in history. The builders have had the ability to pay down rates. If it wasn't the case, new home sales would have gone lower. But apartment construction, multifamily construction permits are at kind of COVID-19 recession levels already. So there has to be some kind of balancing act out there. And I know Sarah and you and I wrote that article in June of 2021 saying that I know a lot of people think there was going to be this big construction boom, but as soon as rates go up, things pull back, right? Builders aren't the march of dimes. I'm just hoping that this is something that gets discussed more and more as the year goes on, that it's not a healthy thing to have housing production this low. For an economy that needs affordable housing, you have to build it. And rates are just simply too restrictive to get any kind of growth out there. And it'll be benefit not only just for the American public, but also for the Federal Reserve's mandate. Because if you're going to fight inflation, more housing supply, right? Supply is the best way. And I'm waiting for the time where they bring that up, that they just come out and say, listen, obviously the housing market has been depressed with existing home sales, and inventory in terms of construction is not growing. We like to be in a more facility, and you don't need 3, you don't need 4, you don't need 5% rates. But we get to that next level, right? 6, just getting down to like 5.75 to 6.25 changes the ball game out there, and you could get things working again. And that's what I'm hoping for at some point this year. That gets discussed, because you can't have housing permits at recession levels for the next 5 or 10 years. Something has to facilitate that kind of a growth in housing construction.
Josh, would love to dig in a little bit on that a multifamily angle with you, right? And one of the things that we've talked about is, from a builder perspective, you have a couple of challenges right now that maybe you didn't have a month ago, which is the tariffs, which we've already talked about. We have the whole immigration workforce concerns that are happening. We have not seen wide-scale deportations. In fact, I think we're at a lower level than we saw during the Biden administration. So that has turned out to be not something that's happening right now. Is that something that you have had to account for in the last month?
It's something we're worried about, but not something we're really accounting for yet. We haven't really seen any impact, but it is something we're worried about. Are people worried to show up to work? They worried to go to school, that type of thing. But so far we haven't seen that. But having said that, I just think, with rates that, when you're borrowing from a bank at this point, and most banks, to be honest, most of the regional banks have overlent and have too much allocation towards real estate. So they're not super motivated to lend on construction and potentially be stuck in a long-term finance situation on more multifamily, even if it's, if the terms are a little bit better. So we're just seeing banks not super anxious to lend on multifamily. And so the projects that started a couple of years ago were getting completed, but we're not seeing a whole bunch of new projects starting. We're seeing a lot of land sitting around waiting, a lot of entitled projects for sale, but no one really with the capacity to pull the trigger because I think most of them need to be done with all cash. And the financing is really working against you right now with cap rates still being relatively low and interest rates being high. So I think we're going to see a real lack of inventory coming on multifamily and office, industrial, kind of all real estate classes, and we're going to be undersupplied coming up pretty soon. And I think that's going to start to drive rates again, or cost and rent rates across all industries in real estate. But for now, the banks are hurting. They're pretending like they're not hurting, and the Fed will probably bail them out if they really start hurting. So I don't think it's a real risk for the economy as a whole. But I think banks really are hurting. They know their balance sheets are kind of out of whack in terms of how much real estate lending they have on their books that's underwater right now.
Parts to that, a lot of people for 2 years now, especially after the Silicon Valley banking crisis, we're talking about, well, credit is going to get tighter and tighter. And a lot of these banks, I mean, we're talking big loans that are going to come due, and that's going to wipe them out. Just for me, generally thinking that the Federal Reserve is going to basically merge a lot of banks. As we could all see what happened in Silicon Valley, you saw something happen over the weekend very fast to prevent contagion from going out. Nobody wants to see credit get tighter and then impact local economies, especially regional banks. So I know a lot of people were thinking, well, that is going to have to break the economy. There's game plans in place for that, but that also means a lot of banks are going to go under or get merged. Of course, to Josh's point, the numbers don't make sense, right? When you build and your cost to build is X, and the amounts of rents you need to take to make it profitable, if it doesn't make sense, you pull back. That's what we saw. We saw a very, very sharp decline in housing permits for apartments. But it also takes, 21 to 24 months to close an apartment. That's double all-time highs. And what's occurring right now is the units that are being completed were things that were started 18 to 24 months ago. They're starting to get finished now, which means that, there's nothing here to work for. And when you have an elevated level of residential construction workers, that is the risk to labor. That's why we talked about 2025, the risk to labor falls into the housing sector in terms of construction workers, because permits have already gone down and the units being completed are finally coming in. So that's something that I'm keeping an eye on. And like the charts that we show all the time, before a recession happens, this sector of the economy always starts to lose job. Why? Fed keeps policy too tight, right? When you keep policy too tight, the future supply of production goes away, so you don't need that much employment. And construction productivity has been terrible post-World War II, so we need that kind of labor. We'll see what happens at the rest of the year. Again, my hope, which I don't really like to hope too much on things, is that eventually it becomes more and more apparent when the units are being completed that we just need to get rates a little bit more to get things going again. This again, not 3, not 4, not 5, but 1% lower in the Fed funds rate, make it somewhat feasible for more production. And of course, the builders can build more single-family homes, as they could sell more single-family homes, and then we get off of this and somehow get the production in line by the time in about 12 to 18 months, when all the units that were in process are done with, we could get supply going, and we don't have to drag housing starts and permits even lower than what we have currently.
I would just say the one thing that really sets the U.S. apart from other countries around the world is our regional banking system is robust and active. I think they do about 70% of real estate development projects are done through regional banks and not kind of the big five. And that's really unique and allows us a really healthy real estate environment. The other thing that's unique with the United States is the federal government essentially subsidizes owning homes. I mean, by not so secretly backing Fannie and Freddie and guaranteeing those agencies, that they are subsidizing housing in a way. And that long-term 30-year fixed rate is just not something you see anywhere else in the world. And so those are assets I think the federal government really wants to protect. They want to keep a vibrant and solid real estate market in the United States. And I think hopefully, to Logan's point, they do pay more attention to what's happening in the short run and the potential risks in the long run, both to regional banking and to affordable housing if you just keep rates a little too high and prevent builders from offering supply. Because it's a supply and demand issue. Demand is down a lot, but some supply is down even more. And demand is going to come back and supply is just not going to be there. So we've really got to be working on our supply right now in a big, big way.
Josh, do you, you were, I assume, working in the industry before Fannie and Freddie were in conservatorship, and then now all these many years of them being in conservatorship. The idea that there's definitely some idea about taking them out under this administration. We haven't seen a ton of momentum yet. What are your thoughts there?
I think in the long run, maybe that's okay. The short run really makes me nervous. I like the federal guarantee. It's kind of nice. Even though I don't think that goes away, I just think it creates more uncertainty. And I think the one thing we're all craving in the mortgage world right now is just some certainty, some direction, and less confusion. You see the CFPB website down, and we don't even know if anyone's working there. And rules changing, and all these things happening. Uncertainty over tariffs, potential rates going up, rates going down. I mean, it's just creating a lot of confusion. It makes it hard to invest in a business when you don't really know what the future is. So I think we could live within the parameters either way if they come out of conservatorship or stay in, but just some clarity and not saying, hey, there's a chance they're going to come out and there's a chance they're not. I do like the idea of Fannie and Freddie being a little bit more nimble and being able to provide products that make market sense and not necessarily have that driven by federal policy that doesn't always make sense. I mean, there's times where, if you have a lower FICO score, you're going to get a better interest rate. And it's like that doesn't really make sense on any level. And it provides a perverse incentive to worsen your FICO score and do different things. So I think there's elements like that would be nice to really take the reins off Fannie and Freddie, let them operate as for-profit businesses. But I really do like that federal guarantee, and I think all the downside that comes with it is probably worth it.
About the subsidization of housing, right? The credit data just came out again today. It happens every quarter. Again, household balance sheets have never looked better because of homeowners, right? There's a reason why the world hates us. It's because we have a 30-year fixed mortgage and they don't. They don't have the plumbing systems that we do. And I think the concern, with Secretary of Treasury Bassett said, we're if this is going to raise mortgage rates, we're not going to do this, right? So there is a lot of confusion on. I mean, there's no reason to do anything right now if that's your goal. And I think that's the pushback that the Treasury Secretary wanted to tell the marketplace. Say, listen, we're not going to touch this. We have a lot of things on our plate, and the last thing we need is for mortgage rates to go up. So I'm not looking for anything to happen anytime soon on that. And they kind of did the groundworks on this, and it's always going to need the government's backing. The Treasury has to come out and provide a line of credit. So this isn't going to be a technical get them out of the government. Government will always be supporting them because they're so massive. But there's a reason why America has a 30-year fixed mortgage, why homeowners on paper, right? Fixed debt costs, rising wages, your wages rise, your debt cost stays the same, you have more disposable income. That's why they subsidize housing so much in that regard. So I don't see them doing anything anytime soon to remotely chance any kind of market risk. But the reason why they subsidize housing so much is when you look at one of the reasons why the economy recovered so strong, why the economy is still very strong in the sense that we've raised interest rates so much, but it didn't break the economy. Why? Short-term rates versus long-term rates. Long-term rates are fixed. So much of the debt in America, not just households, but corporations, were fixed already. And that's the benefit. Where countries like Canada, Australia, Norway, a lot of those countries are tied to short-term rates. We always joke about how Canada has to do 90-year loan modifications. Not in America. That's our golden egg, and it's really helped the recovery, helped the COVID-19 recovery. And even with rates moving up so fast, you could see this in the credit data, how homeowners, majority of consumption is the middle class and the upper class, but that class is doing well because their debt profiles are looking good. Young households, renters, not so much, right? We see the credit stress into there, but homeowners on paper look good for a reason, right? We've subsidized housing so much to get people into a home. It's not so much of the home values that go up. That typically goes up with inflation, but it's the cost of housing. Fixed debt costs, rising wages. The longer you live in a house, the better disposable income you have. So that's the benefit of the United States of America over
and there's nowhere else
every country in the world.
There's nowhere else you're getting a 30-year fixed loan. I mean, even the federal government with their balance sheet doesn't have a 30-year program. So, they've got the 10-year. A lot of people wish they'd done the 30-year program when rates were at 1%, but they didn't do it. But you're as a commercial developer, a real estate owner, you can get a 5, 7, or 10-year, but we wish we could do a 30-year option. But it's just this is reserved for the American homeowner, and really it is just it's a real special benefit that Americans have to be able to get into home ownership and have essentially a subsidy from the federal government to do it.
Well, we are out of time already. That went really fast. Great episode. Josh, thanks so much for joining us. Logan, as always, thanks for being here, and we will talk again soon.
Appreciate it. Thank you.
My pleasure. And I still have the Gandalf doll. Josh and I, when we went on a stage and talked together, he gave me a Gandalf doll to represent the 10-year yield bottom call back in 2023.
I will say our company is still talking about that visit. You did a phenomenal job. It is amazing to have both of you guys come out and speak to us, and it brought a ton of energy. It was a lot of fun, so I really appreciate that.
It was so much fun, and I do think that's one of the best gifts you've ever gotten, Logan, from fans or from the podcast. So thank you guys so much, and we'll talk again soon.
Thank you.